It's true that having been buffeted this way and that by stock markets in recent years, and cash having offered zilch for the best part of 15 years, now it's offering a decent return again. Great. I'm happy with that. I'm not a greedy person. I just want my regular income to come in. A lot depends on the time horizon. I mean, we say in the book, and I know that FPC have always been strong on this, that all investors ought to have a buffer of cash, because you often don't know when you're going to need cash, and even more certain, you do not know when so-called bad times are going to arise in markets. And even if you don't want, if you don't need the cash yourself, there may be interesting investment opportunities that arise that you want to take advantage of. We're big believers in the flexibility offered by having a buffer of cash. We think that private investors generally throughout the world have large proportions of their wealth in cash, and seemingly always have done. Although it's often difficult to disentangle that, but that does seem to be the substance of the situation. And this does mean they will now be generating levels of income from those cash holdings that they haven't enjoyed before. But we do think you ought to maintain that. Now, should you sell your equity investments in order to sort of build that up and enjoy the return? It depends on your time horizon and what your and what you want to do. But assuming that you're an investor for a number of decades, or investing on behalf of your children or your grandchildren or whatever, actually it makes sense to have a balanced portfolio as ever, and to invest in risk assets, equities, corporate debt, things like that, because we do think that will compound over time to your benefit. It needs, as always, to be in balance. But the idea that because of short-term interest rates, you should move stuff out of stock market into cash in any big way, one might get away with it once, and one will think how clever one is. That the likelihood is, and the data on sort of experience of investors almost throughout time, is that it's extraordinarily difficult to do that successfully. Very few do, and it's wisest to assume that one isn't that either a very unusually skilled person, or more, or just lucky person who manages to get it right. You have to assume the default is you'll get it wrong, and actually you can do a lot of damage. And there's almost nothing more damaging than being lucky on something like that, because it encourages what we would consider to be unstable behavior going forward in the future.